Welcome to this explainer. Today, we're unpacking the fascinating landscape of Bitcoin ETFs as of April 2026, and we're going to examine exactly how these specific financial instruments are actively reshaping both our domestic and global markets. The intersection of traditional finance and digital assets has literally never been more active than it is right now. We've officially moved way past the early days of wild speculation and straight into an era of deep structural integration. So let's dive right in to understand how we actually got to this point, and more importantly, where we're heading next.
Okay, let's start with the basics. A Bitcoin ETF functions as a critical bridge. It completely bypasses the friction of self-custody, things like managing private keys, writing down seed phrases, and dealing with specialized crypto exchanges. Instead, it allows traditional capital to flow directly into digital assets through the standard brokerage accounts people already have. The fund holds the actual Bitcoin, and you just hold shares in the fund, giving you direct exposure to price movements completely seamlessly. This structural mechanic is exactly what has unlocked vast institutional and retail liquidity on a truly global scale.
And that brings us to a crucial question for anyone who's watching the markets today. How exactly have these funds altered the DNA of the crypto ecosystem now that we're deep into 2026? Because, let's be real, the introduction of these products wasn't just a minor software update to the financial system. It was a massive paradigm shift that completely changed the players, the rules, and the entire scale of the digital asset space.
To answer that, here's our roadmap. 1. The 2026 crypto landscape. 2. USA adoption driving forces. 3. Impact on global investors. 4. Weighing pros and cons. And 5. Future market predictions.
Section 1. The 2026 crypto landscape, bridging the gap between two financial worlds.
The fundamental shift over these last few years is just undeniable. Think about it. Bitcoin is no longer siloed off for tech enthusiasts or early adopters reading complex white papers on niche internet forums. By 2026, it is sitting comfortably right alongside traditional stocks and bonds in everyday retirement portfolios and corporate pension funds. The narrative has completely transformed. The massive infrastructure required to support these ETFs has forced a level of maturity and standardization onto the crypto market that simply did not exist a decade ago.
Section 2. USA adoption driving forces, the epicenter of the shift.
So what's actually fueling this? Well, 3 specific driving forces have been the primary engines powering the ETF surge in the US. First, we have the integration into Wall Street infrastructure, which means Bitcoin is now fully supported by the absolute biggest custodians and clearinghouses in the world. Second, evolving regulatory clarity gave a massive green light for institutional products. Once those rules of the road were finally defined, the traditional hesitancy just vanished. And third, that newfound clarity unlocked a huge influx of traditional institutional capital. We are literally talking about trillion-dollar asset managers allocating a percentage of their vast portfolios into Bitcoin, which creates a powerful long-term floor of demand.
To summarize the American situation right now, the status quo is crystal clear. Mainstream integration has been definitively achieved. It's established a powerful blueprint for traditional finance. The United States market has proven, beyond a shadow of a doubt, how legacy systems can successfully absorb and offer a decentralized digital asset, all while operating at the very highest levels of global finance.
But we can't just stop at the borders, right? Which leads us to ask, how is this incredible concentration of American adoptions sending shockwaves to global investors? Because when Wall Street moves on a new asset class this aggressively, you better believe the rest of the world doesn't just sit back and watch.
Section 3. Impact on global investors, the international ripple effect.
And this sets off a fascinating domino effect. Step 1, US validation essentially de-risks the asset on a global scale. By approving and successfully integrating Bitcoin ETFs, the US basically signaled to regulators everywhere else that the water's fine. Step 2, this sparks a massive chain reaction. International markets across Europe, Asia, and beyond are rapidly launching their own competitive ETF products to ensure capital doesn't exclusively flee to American funds. And finally, Step 3. Ultimately, global investors, from everyday retail savers in London to massive institutional funds in Tokyo, are gaining unprecedented, seamless, and fully regulated exposure to the crypto market right in their own local jurisdictions.
Section 4. Weighing pros and cons, an objective look.
Now, the core debate in 2026 is a profound philosophical and practical tug-of-war. On the pro side, ETFs bring unprecedented mainstream adoption and flood the market with enhanced liquidity, making Bitcoin a much more widely accepted asset. For everyday investors looking for easy portfolio diversification, it's a huge win. But if we flip to the con side, pooling massive amounts of Bitcoin into the hands of just a few giant traditional asset managers introduces some pretty severe centralization risks. Actually, it's a very sharp departure from Bitcoin's original, highly decentralized ethos. Plus, plugging Bitcoin directly into Wall Street makes it incredibly vulnerable to the exact same traditional market manipulation and systemic risks that it was originally created to hedge against in the first place.
Section 5. Future Market Predictions, looking beyond 2026.
Looking at the timeline for the next few years, we foresee deepening institutional roots through 2027. This means we're going to see even more pension funds and university endowments adding Bitcoin to their balance sheets just as a standard practice. Following that, from roughly 2028 to 2030, the trend strongly points toward a harmonization of global crypto regulations. Major global economies will very likely agree on shared, standardized rules for how these digital assets are audited and traded across borders. Ultimately, moving into 2030 and beyond, the broad expectation is the complete integration of digital assets into traditional finance. Managing a Bitcoin ETF, tokenized real estate, and your traditional blue-chip stocks will happen in one single, unified dashboard, becoming completely indistinguishable from legacy financial vehicles.
As we wrap up this explainer, I really want to leave you with this final thought to ponder. As these ETFs continue to successfully bridge the gap, literally pouring billions of traditional dollars into decentralized networks, are we heading toward a future where the line between Wall Street and crypto is completely erased? And if so, does crypto change Wall Street, or does Wall Street ultimately change crypto?